Okay, awesome. Okay, so today we're going to talk about the 5 reports you need to run each month. And, you know, what I'm trying to do, what we try to do with our clients is kind of break this down into something that's digestible, that's easy to implement, that is also, you know, at least hits the high points in a short period of time. So these are the 5 reports. We're going to give you some insight, knowledge on how we do our reviews with our clients. These are the reports that we run each month, and I'll tell you a little bit about those in a minute. Okay. So if you guys aren't familiar with who we are, my name is Anna Masker. My business partner Mel Comer and I are the leadership team of ProfitLink. We do CFO, accounting, and advisory services for companies in the tech and creative agency space. Everything from the tactical bookkeeping to controller level insights to accounting technology implementations to the CFO level stuff, budgeting, forecasting, financial modeling, etc. So we always have this disclaimer. This is an open Q&A session. It's really for informational purposes only. Excuse me. We aren't here to provide tax or legal advice. So if you need to get tax advice, call somebody like Rich Lipton or your tax advisor who knows your personal situation. If it's anything legal, obviously go to your attorney. Okay, so what we're going to cover today is pretty basic. Why regular reviews are important, the basic financial statements, an overview, why we call these 5 reports the starter pack. Of course, what are the 5 reports? How to find cash, catch errors, and spot trouble in each of those 5 reports. And then also what you won't get in these reports, that's important also to know as well. So, and also letting you know how we as ProfitLink can help do your financial reviews. Okay, so I would like to know, let's see, what do you guys want to learn today? So let me just do this, and can you guys see the poll? Okay, can you guys, can you see the poll that I put out there?
Yes, we can, Anna.
Okay. All right. Okay, so why don't you just go ahead and answer, and we'll just kind of get an idea of what everybody is interested in learning today. Because this way we can also tailor our topics around that as well. Okay, I'm going to end the polling in 3. Okay, everyone voted. Okay. All right, so let's take a look at the results. So how to spot trouble is a big issue. Okay, finding bookkeeping errors, that's always a big hit. Looking for different ways to review my financials and getting better at reading financial statements. Excellent. Okay, so we're going to cover all of those today, so you're in the right place. Okay. All right, so let's start this. You know, I want this to be engaging. So if you have questions, put them in the chat, but I also want us to interact a little bit as well. I know financial reporting can be pretty dry, so we're going to have a little fun here. So I want to know, how observant are you? Okay, let me just move this out of my way here. Okay.
This is an awareness test. How many times does the team in white pass the ball?
Okay, in the chat, tell me how many times you saw them pass the ball, assuming this ball hits this lady. Okay, 12, 12, 13, 7, 14. Okay. We have one right answer.
If you answered 13 passes, you are correct. But did you see the moonwalking gorilla?
Okay, so did everybody see the moonwalking gorilla?
This is an awareness test.
So how true is that normally? In our day-to-day lives, we're so busy passing the ball to each other, within our team, firefighting every single day, and something like a moonwalking gorilla can walk through our business and kind of upend it. So what we're trying to do with financial reports is to really, what I call, spot the gorilla, right? Find the hidden cash, spot the troubles, and catch the errors, and give yourself that time once a month at a minimum to actually go through and look at your financials so that you are taking that step back. I will tell you, if you ever go back and watch that video, you can never not see the gorilla again. So that's what we want to get to, is always being able to spot the gorilla when we're doing our financial review. There's a couple of things that make a financial review helpful. Why they help you? It's because it helps you refocus once a month. It regularly measures performance, and more importantly, it helps you course correct before it's too late. When you don't have timely financial reviews and you're closing your books a month or 2 months afterwards, it's too late to course correct. So having them to have successful financial reviews, you absolutely need to have them to be timely. In our world, we like to have them done within 10 days of the end of the month, maximum. And also thorough, looking at more than just your P&L. A lot of people, that's their comfort zone, right? Everyone knows the profit and loss statement, the revenue and expenses, not too hard to do. But when it comes to the balance sheet and income statement, balance sheet and cash flow statement, those are a little bit more challenging. And then you want to have an action plan to solve the problem. It's great to say, shoot, we have some issues, but if you don't put that action plan together, then that is what you review in the following month. In addition to your financials, it's kind of worthless to spend that time. All right, so one last poll, and then we'll get into the 5 reports. So tell me, how comfortable are you currently with your financials on a scale of 1 to 5? Okay. All right, we're going to end the polling. I'm going to share the results. Okay, so this is helpful for me so we can tailor this. So it looks like people have a basic understanding, a solid grasp, but always can learn more. And 2 of you are fluent in your financials, and I can guess the 2 that are on this call that are pretty fluent. So we're going to take a look at the financial statements. We're going to give you a quick overview of what each of those statements are, and just so we have a refresher. Okay. So in every business, no matter how you're structured, what industry you're in, you have 3 financial statements. The first is the profit and loss statement, also called the income statement. Very simply, revenue expenses is what's on it, tells you the profit and loss of the business. Your balance sheet is a little bit less, for new entrepreneurs, is a little bit less intuitive. What's included on the balance sheet are your assets, liabilities, and equity. In simplistic terms, it's what you owe to other people, and what you own. So your assets are what you own, your liabilities, assets and equity are what you own, and your liabilities are what you owe to people. And the third financial statement tends to be really not known. Most people don't even run it. But I'll tell you one thing, it's the first place I look when I go to when I get a new client. We look at the balance sheet first, and then I look at the cash flow statement, because that tells me truly the health of the business. On the cash flow statement, there are 3 lines that we tell our clients to look at. We're going to look at these in a bit. First is cash flow from operations, cash flow from financing activities, and cash flow from investing activities. It answers the $1 million question that everyone asks, like, okay, I sold $2 million of business. I don't have $2 million in my bank account. It answers the questions of where did all my money go? So let's look at the 5 reports. So what are they? The 5 reports we run each month is the P&L by month, the balance sheet by month, cash flow statement by month if it's available. So if you're using QuickBooks Desktop, for example, that's only available on a per period basis. If you're using QuickBooks Online, you can get that by month. And then the accounts receivable aging, accounts payable aging. I bet a bunch of you are probably running at least 2 of these reports, the P&L by month and the accounts receivable aging, maybe even your AP aging, accounts payable aging report as well. Okay, so what we're going to look at is the P&L by month, and we're just going to go through the major categories. No matter what industry you're in, they all kind of fall into the same buckets. The first is revenue, that's self-explanatory, and then cost of goods sold. Cost of goods sold are expenses that are directly tied to generation of revenue. So what does that mean? That means if you have material costs, if you have labor, if you have contractors that are delivering your services for you, if it's things that vary with the volume of revenue that you have. So revenue minus cost of goods equals gross profit. Gross margin, profit margin are also interchangeable ways that you can talk about gross profit. Then the next section down in your P&L is your operating expenses. That includes your fixed costs, your overhead, your selling, general, and administrative. This is your rent. This is your office expenses. These are some of your fixed costs that don't vary with the way your revenue goes up and down. So you take your gross profit minus your operating expenses, and it gives you operating income. Then there's this other section on the bottom underneath operating income. Oh, let me go back. Operating income actually is the income that's generated from the core operations of your business. So this other income and expense line item really is all those, wonky things that happen during the year. So if you happen to have a business savings account that earns you 0.000001% per year, and they deposit 3 cents into your account, once a month, that would go into other income and expense. That's where we typically put it. Anything for us when we're analyzing books or we're cleaning up financials from previous accounting, bookkeepers, whomever, and we have some cleanup work to do in the current year for previous years, we'll sometimes put that in other income and expense so that our operating income is really pure as far as what's the impact on what's the viability of the business this year and the results. And then of course, operating income plus or minus other income and expenses, depending if it's what the balance is, equals your net income. Pretty simple. I think this is probably the report that everybody knows. And so, I pulled, let's take a look. So let's take a look and see what we look at when we look at a P&L report. And I really like the P&L report by month because this tells us a ton, right? So you've got your accounts down in the rows and the months across the columns. I only ran this for 6 months just so this doesn't become an eyesore, but we typically run 13 months. Right? So then we have, what June of 2017 was compared to June of 2018. So the 13 months gives us a really nice view. Couple things we look for. We look for seasonality. Sometimes clients don't realize there's actually seasonality in their business. Whether it's discrete or it's really overt. Sometimes when you run this report, you can actually see trends. And if you pull it out over 2-3 years, you actually can see some trends that, the client wasn't aware of. And what that helps us do is plan from a cash flow perspective. So if we know that we're going to have some seasonality, we're going to have some spikes, and we're going to have some dips, then we know how do we should reserve some cash. We should, be prepared for that. So it's important that you run it across multiple months. So some of the common errors that we see, let's start there. We'll see things that happen where revenue or expenses are in different time periods. So let's say you sold something, but you sold something in January, but you didn't recognize the cost until February. You're going to have a mismatch there. Your profit margins are going to look great in January. They're going to look really crappy in February. So what we want to do for what we call accrual-based accounting is kind of get those revenues and expenses matched in the same time period. Those are common errors that we see. We will also see things like what we see here, right? Something didn't get booked for cost of goods for June. You're going to see this, obviously a zero is going to pop out at you, but it pops out a lot more when you see some trends, including the income. You've been in this company, they've been ramping up, and then June really fell off. So it sparks conversations as to what's going on. Could it be a timing issue? Could it be, production issue? Could it be something along those lines, a sales issue? I always like to say if you have a problem in your business, it flows to the financials. Everything flows to your financials. If you have an income problem, an operations problem, an HR problem, a productivity problem, we're going to see it. So knowing where to look is important. Okay, so you have some obvious errors. So you've got some bookkeeping errors that you can catch here by looking at the trends. You can see some business trouble by looking at the trends. We also see some issues where we have cost of goods. This is just a summary level, but sometimes we see another error that we see is that when cost of goods labor is classified as overhead. So for those industries, especially those that are in the services industry, you might want to look at your total job profitability, and to do so, you need to allocate your labor appropriately above the line, meaning gross profit up into cost of goods. So that's a common thing that we see with a lot of clients. And the reason why you want to do that is you really want to look at your gross margin. This is the profit that's being generated from your activities. And so this number needs to be relatively consistent as a percentage of sales over time so that you can spot issues. If you have a lot of your costs buried below in operating expenses, it's a little muddy. And so it makes it hard for you to really get some good analysis on what's going on with the business. So let's see, mismatched time periods, misclassification of cost of goods, inconsistencies on how expenses are being booked. If you see something like this, okay, what's this $13,000 or $1,300 credit? Is it misentered? Is it, is there a credit, something? So it pops things out. And then by looking at it across months, you can see the consistency. And if you can see things that maybe, got booked in from office expenses to facilities or something like that. So that's how we catch some of the bookkeeping errors. Where cash gets hidden on the P&L, it's pretty straightforward. I think a lot of people sometimes think of the P&L or the profit as cash flow. If you've ever seen a big number on your P&L and you don't see that corresponding number in your bank account, you understand why. Profit and loss is very different than cash flow, which we'll talk about in a second. So, common cash issues, obviously increasing expenses, lower revenues, that's where you can find cash on your P&L statement. But by looking at trends, it's really going to help you. I like this better than the year-over-year comparative because I find it much more telling. Okay, so the next financial statement we're going to look at is the balance sheet. Okay, again, we run the balance sheet by month. Again, gives us a lot of trend information. Balance sheet is broken into 3 categories: assets, which includes things like cash, inventory, equipment, accounts receivable, Your liabilities are what you owe to people, accounts payable, credit cards, lines of credit, term loans, leases, you name it. Equity is the combination of the owner's contributions and distributions and retained earnings over time. So everything that you've put into the business, taken out, and your profits aggregated is in equity. Okay, so on the balance sheet, let's take a look at the balance sheet. Okay, on the balance sheet, we have the same issue, right? So one thing with the balance sheet that's different than the P&L is that the balance sheet is a point in time. Think about your mortgage statement. When it comes in the mail or electronically, it tells you what you owed at the time that they cut that statement. So whether it's the end of the month, it tells you the balance of what you owe. Same thing with the balance sheet. These are point in time snapshots of your financial health of your business. Most bankers come to the balance sheet. I go to the balance sheet, and probably most accountants go to the balance sheet first before your P&L. This tells us the health of the business, whether looking at the ratio between the assets and liabilities is a big one, and how quickly you can turn your assets into cash and how you can cover your liabilities. We're not going to cover that in this 5 reports. Right now, we're just going to look for trends, okay? One thing we look for, knowing that there, with a caveat that this is a point in time analysis, is we kind of look at trends for, cash. Are our cash balances increasing? Are our accounts receivable balances increasing? Are our liabilities increasing? We look at trends across the board. We also look at things like, here's where you could find bookkeeping errors in depreciation. So most of you work with an accountant. We like to work with our accountants, our clients' accountants, to get the depreciation entries, and these should be booked monthly, so that you have a nice flattened profit and loss statement. So you're not booking these year-end adjusting entries in December, so that you have a better idea of what's going on in the business. So if we get those in right now, so in this case, the accumulated depreciation expense has not been changed over the 6 months. So that tells me the bookkeeper hasn't gotten the entry or hasn't booked the entry for accumulated depreciation. So what normally happens in this situation is the accountant will get the books at the end of the year, and then they'll say, oh, we need to write off, I don't know, $50,000 of depreciation across the various categories. So from a P&L perspective, you look like you're doing okay. And then all of a sudden, if you look at December on a chart, it's like, whoop, huge losses in the last month of December. Because a lot of the CPAs, honestly, at tax time, don't have the time to spread that out over months. So that's why we like, from a bookkeeping perspective, to have those things booked monthly. A lot of common errors that we see on the balance sheet are assets and liabilities misclassified. A lot of times we'll have what we call flip-flopped balances, meaning if you're using QuickBooks, most of the balances should be positive with the exception of things like depreciation. So if you see a negative where there should be a positive, this is depreciation. If you see a negative when there should be a positive, that's an obvious sign that you've got some bookkeeping errors in there. The other thing we see is on the P&L side, we'll see huge expenses for like, oh, I just bought this like major piece of equipment. Well, that really is an asset. It belongs on your balance sheet. So most of the times, again, the CPA will move those from the income statement to the balance sheet, but that can impact your earnings. We want to see those assets capitalized when at the time. We also see issues with not classifying payments to principal and interest. So a lot of times, lower level bookkeepers will take a, payment for a loan or a line of credit and put the whole thing against the balance on the balance sheet. Whereas some of that payment is interest, some of it's principal. So we want to make sure that the principal goes on the balance sheet and the interest goes on the income statement. So we see a lot of times we got to clean that stuff up. Where does cash lie on the balance sheet? Well, lots of places. Accounts receivable, or let's call it cash opportunities. if your accounts receivable balance is growing, and we'll take a look at that as one of the reports, disproportionately to your sales, it's not a 1-for-1 ratio, but we do kind of take an eyeball look at that. That's where cash can get tied up. Basically, I think a lot of times when we talk to clients, I say, your other line of business is a bank, right? If you're extending credit to your clients, you're also a bank to them. So think about it that way when it comes to receivables. And I think all of us in this time of COVID are extremely focused on receivables and cash. And if not, I hope you are. You definitely need to be. If you have inventory that keeps building, where you have cash tied up in inventory or other assets, like you've bought a lot of equipment or trucks or things, that's where cash can hide. And when you start looking at ratios, which is not part of the starter pack of 5 reports, that's where you're going to start to see, like, what are my return on all these assets, and where might there be opportunities to take a second look. The other place you'll see cash coming out of the business is when you see big disbursements out of the equity. So if the owners are pulling a lot of money out of the business, you'll see this in the distributions. That's anything above and beyond payroll, typically. Okay, so that is your balance sheet. Okay, the cash flow statement, let me just put this down here. Okay, the cash flow statement, this is a little bit harder to understand. It's a lot of accountant speak for those of you who aren't accountants, obviously, on this call. But it's very simple in the sense of, it starts with your beginning cash balance, it adds the cash flow from operations, and the other 2 categories. So we're going to break this down in a second. So beginning cash balance, cash flow from operations, cash flow from investing, and cash flow from financing. That gives you an ending cash balance. Okay, and then and you look at the change between the beginning and the end. So let's break it down. Cash flow from operations is basically the best number to look at, I think, in a financial review. That tells us how well your business is generating cash. Not only profit that you'll see on your P&L statement, but how well are you turning that operating income into cash flow. So cash flow from operations should always be positive. Cash flow from investing activities are if you are buying equipment, if you're buying things that are long-term assets for your business. Yep. That will fall into the cash flow from investing activities. Cash flow from financing, this is where you're going to see your PPP loans, you're going to see your EIDL loans, you're going to see your term and line of credit. That's all financing activities, as well as any money you've put in the business or any money you've taken out in distribution. Those will come into the cash flow statement. So we're going to take a quick look at the cash flow statement. And here we go. Okay. So behind these 3 categories, so I tell my clients, just look at the 3 subtotals because you'll get confused otherwise. And I'm not downplaying it, but this is what it kind of looks like. Pluses, minuses, and basically it's an accountant's view of sources and uses of cash. But for our clients, what's important are these 3 numbers. Your cash flow from operating activity should always be positive. This tells us that the business is generating cash on its own. I like to look at this again over months. This was from a desktop QuickBooks file, so I couldn't pull it. But I do like to see, if I have a negative 1 month, that's a big warning sign. But if it's cashed over a couple of months and I can see the relativity of it, it makes a little bit more sense. Cash flow provided by investing activities, this is money you're sending out, like you're spending for things to grow your business, equipment, trucks, computers, servers, whatever it is. And that's okay if it's negative. It means that you're investing in your business. Cash provided by financing activities can be relatively speaking, can be positive or negative. Whether you're paying down existing loans, it'll be negative. Just think about it as cash going out of your business, or you're drawing a lot of money out of the business. This is the sneaky one that I think a lot of people don't realize, like, how much sometimes when owners are pulling money out of the business, how it's starving the business of cash. And sometimes that's something we recalibrate with our clients so that they leave enough money in the business to fund cash flow. Okay, so that's the cash flow statement. Let me make this smaller. Okay. Accounts receivable aging report lists the customers and how old their outstanding balances are. A lot of clients use this, and the accounts payable aging report, same thing, lists the vendors and how their outstanding balances. So we're going to take a quick look at those, only just to show you some places that we see issues with. Here's an AR aging, accounts receivable aging report. We like to look obviously at the columns here and say, what do we have? Who hasn't paid us, right? So that's a pretty decent sized balance in your 90-day and 60 and 90-day category. Sometimes, we're doing ratios, we look at the percentage of 90-day of the total in each one of these categories over the total, kind of track that over time to see if we're moving, our collections team is moving in the right direction. As far as for some of the errors that we see from a bookkeeping perspective, unapplied payments, sometimes you see a positive and negative that equals 0. It means that, they never applied this $3,000 payment to a customer. The other thing we see, that's a red flag for us when analyzing our clients, this is where cash can get tied up. You've got a $9,000 balance for customer E, 6,000 of it, which is old, yet you're still selling to them. So, that's a question we'd ask, what's going on with this account? Like, they could be strategic, they could just have slipped through the cracks, but looking at, do we have balances with clients, and are we continuing to sell to them? And what's the logic behind that? But overall, this client's in relatively decent shape. On the AP aging side, oops, this is a little bit big, but same thing. We look at the clients, we look at the vendors and see, okay, what do we have outstanding? So if this balance is growing, that's not necessarily a bad thing. Just like you are a bank to your customers, your vendors can be a bank to you. Where we see this go south and very quickly is if this is not a managed cash flow plan, right? So whether you've negotiated longer terms with your vendors, that this may be okay, but what we often see is clients use their vendors and then get into such a cash pinch that they're not able to meet these obligations. So this has to be managed. This will tell us, like, if we see a lot of AP aging growing, we'll have conversations of like, what's actually going on here? Like, what are going on? What's the deal with vendor 2? So an AP balance, especially in these days, a growing AP balance is not a bad thing, but it has to be managed within in a cash plan. Okay, so I know this was a lot of information. There's 5 reports. It probably should take you about maybe 15 minutes to run the reports. In QuickBooks, you can save them as favorites, whatever, or have your bookkeeper or accounting team run them for you. But we call this like the starter pack because it doesn't tell you everything. It's a good first, step. Because they show you everything at the total company level. What they don't show you is 100% of the errors. We capture a lot of errors by looking at that trend analysis and looking at the AR aging and AP aging, but there are some nuances within the accounting that can get you into pretty hot water. So on the surface, it may look like it's okay. We don't capture 100% of those errors. So it's not foolproof. Here's the other thing that we find ourselves sometimes guilty of as well. When you're looking at things at the top level, it's easy to explain things away. Oh, yeah. I forgot. Yeah, we made that purchase or we did this. It doesn't allow, by just looking at things at the highest level, you don't look at them very systematically. So you need to take a deeper dive because the truth is in the details. The other thing is the starter pack, these 5 reports are all historical. They're all rear facing. They don't take into consideration future looking issues, budgets, forecasts, and especially in our world, which has changed so dramatically in the last 6 months, historical doesn't always represent the future. And I think most of our time needs to be spent looking ahead. We have a healthy respect for history. We know it helps us know and course correct, but we still need to be thinking of the new world as it is today. I did allude to some of the ratios that we run. That's not, doesn't come out of the starter pack in QuickBooks by any means, but we do deeper analysis, KPIs, key performance indicators, ratios. That leads you, yields a more insightful picture when you're looking at financials. So this starter pack takes you about 15 minutes to run. And when you get good at it, it takes you less than an hour to run through all 5. If you just stop there, you're in decent shape. Like, it's a good step forward. And then what's probably going to happen, which happens with all of our clients, we start at that level, and then there's always questions at that next level. Why do you need to go beyond the starter pack? Well, you can't drive a car by looking in the rearview mirror, especially in this day and age. You don't have the analytical ratios, but also the benchmarking. You know, looking at where you stand versus your competitors versus the industry. And then if you're only looking at things at the highest company level, you really can't, when it comes to cost cutting or taking action, it's really, you have to go with an axe versus a scalpel. So if you're trying to fix issues and you know the source of the problem at the granular level, easier to make a change to a customer or a vendor or a specific product line versus having a P&L that tells you, you know, your profit margins are down, and then you have to dig to kind of figure it out. So that's why it's important that you go beyond the starter pack, but this is at least a good first start. So just to give you some insight as to how we work, we do a couple of different things. We do financial coaching, meaning we can help improve your leadership team's financial fluency. And this isn't over a course of, you know, a number of months. You know, we take it at a pace in which clients can understand, and that's super important for us. You know, we can give you all the answers at once, but if you can't, you know, process them or, you know, have to understand them, it takes us a long time. The other thing we've done in the past, and we continue to do, is work with clients' in-house accounting team to start thinking like a CFO, start anticipating the questions that you have. A lot of our clients come to us and say, geez, I wish if you know, so-and-so only asked that next question of, like, you know, why does that look unusual, and find the answers themselves. I think the challenge is a lot of folks started in, you know, accounting, there's really not a resource for them for that coaching and training. And so we do that for clients. We don't have to step in as the CFO, but we actually can help train some of the in-house staff to start thinking analytically and start thinking like a business owner too. A lot of times our clients, you know, the accounting staff is an island within an organization. You know, they're working with the CPAs at the end of the year and they're getting some support, but it's the daily operational stuff that sometimes they get hung up on. And only if they had, you know, some resources, or they, you know, upskilled them a little bit, it would be, you know, they can do so much more. We also do accounting support, that's bookkeeping responsibilities, controller oversight. If you have an in-house team and you just need the books closed accurately, you know, we'll do that 5-pack starter, you know, do that analysis, or train the team to do the analysis. And then we'll also do the closing, the monthly financial reports, the KPIs, depending on what you need. And then of course the CFO support. That's analytical reviews, establishing the KPIs, the budgets, the forecasts, the financial modeling, and then also quickly spotting that moonwalking gorilla that walks through your business. And while you're juggling that ball, we can spot that, those things that are walking through. So that's all I had. Thank you for hanging in there. Let me just see, I don't know if there's any chats. Okay. Okay. So we question, we find cost of goods, inventory, and WIP burdensome and typically do real inventory only once a year. How significant is this? You know, it depends on the size of the inventory and the value of it. So a solution might be periodic inventories for you, where you are taking 2 or 3 or a section of your warehouse and you're counting each one of those, you know, a couple of those things periodically throughout the year. So you have a cycle of things that you count periodically, and then you make adjustments to the to your inventory balances in your system. So that's a good mid solution, because I know it's really disruptive to run a physical inventory. Like you have to shut everything down and you have to get everybody, you know, pay them to count. That still needs to be done once a year. That's best practices, but periodic physical cycle counts, we call them, are also really helpful. Okay, one question came up. What industry sectors do we specialize? We've run the gamut across the board. We specialize or kind of focus on technology and blockchain companies, as well as creative agencies, and also professional services companies as well. We typically don't work with too many clients that have inventory, just because our remote virtual partial model doesn't always work very well in that situation. But, you know, happy to have conversations with anybody who's, you know, interested. So my contact information is up on the screen, and feel free to reach out if you have any questions on what we do or anything we talked about. I am going to send this recording out, so if you have any questions, please don't hesitate to ask. Okay. All right. So I hope you guys enjoyed this. I hope this was informative. Please let me know if there's anything we can help you with. Otherwise, have a great day.
Thanks, Anna.